Welcome to StokTok's deep dive into Marsh. Marsh is one of the world's leading insurance broking and risk advisory firms, helping corporations and institutions navigate complex risk exposures. At the time of recording, the stock is trading at 175.8, sitting well below its 52-week high of 235.78. and modestly above its 52-week low of 164.89. The 50-day moving average sits at 175.66, while the 200-day moving average is at 187.82, meaning the stock is trading beneath its longer-term trend line, a technically cautious setup. The 14-day RSI, a momentum gauge running from 0 to 100, reads 51.6, which places it in neutral territory. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Marsh generates the majority of its revenue through insurance brokerage commissions and advisory fees, acting as an intermediary between large corporate clients and insurers. The competitive moat here is built on deep client relationships, proprietary data, and the high switching costs inherent in enterprise risk management. The StokTok score comes in at 46 out of 100, a caution signal. Valuation scores 6 out of 20, financial health 8 out of 20, profitability 13 out of 20, growth 11 out of 20, and smart money 8 out of 20. Across the board, the picture is mixed. Now, valuation. The question every investor has to answer: are you paying the right price? Marsh carries a trailing price-to-earnings ratio of 21.98 times. That is the current price divided by the last 12 months of reported earnings per share. The PEG ratio, which adjusts the price-to-earnings multiple for expected growth, stands at 1.43. A PEG below 1 is generally considered attractive. Above 1 suggests the market is already pricing in a meaningful growth premium. The forward price-to-earnings ratio of 17.08 times is more constructive, implying the street expects earnings to expand from here. The enterprise value to EBITDA multiple, a debt-adjusted profitability lens widely used in credit and acquisition analysis, reads 14.77 times. In our view, the economic moat here is real. Marsh benefits from sticky client relationships and high switching costs in enterprise risk advisory, which typically justifies a premium multiple relative to simpler financial intermediaries. The GuruFocus intrinsic value estimate at the time of recording stands at 249.45, implying a margin of safety, that is, a discount to estimated fair value of approximately 29.52% at the current price. That is a meaningful gap. Wall Street analysts at the time of recording have a consensus mean target of 204, with 21 analysts covering the name. The high estimate is 236, and the low is 179. The next earnings report is due July 16, 2026, with the street expecting earnings per share of approximately 2.93. That is a near-term catalyst worth monitoring closely. Market sentiment around Marsh, as of the creation of this video, leans neutral, with insufficient recent news flow to tilt the signal in either direction. The price-to-sales ratio of 3.14 times is not demanding by financial services standards. In our view, the valuation setup is moderately interesting, though the low StokTok valuation score of 6 out of 20 reflects the elevated debt profile we will address shortly. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point checklist of profitability, leverage, and operating efficiency signals. Marsh scores 5 out of 9, a middle-of-the-road reading that suggests neither a deteriorating balance sheet nor a pristinely strengthening one. The Altman Z score, a quantitative model designed to estimate the probability of financial distress, sits at 2.70. This places the company in what analysts call the gray zone, above the distress threshold of 1.81, but below the safe zone of 2.99. That warrants attention. The cash-to-debt ratio of 0.07 is low, meaning the company holds very little cash relative to its total debt load, leaving limited cushion. The interest coverage ratio of 6.25 times tells us that operating earnings cover interest expense just over 6 times, serviceable, but not exceptional. The current ratio of 1.11, current assets divided by current liabilities, is marginally above 1, indicating the company can meet near-term obligations, but without much buffer. Debt to equity stands at 1.54, meaning the company carries notably more debt than equity on its balance sheet. In our view, the balance sheet here is a constraint rather than a competitive asset, and we would want to see leverage reduction over time before declaring the foundation robust. Next up, profitability. Is this business actually making money efficiently? We lead with return on invested capital, the return the company generates on every dollar of capital it has deployed into the business. At 8.7%, it is positive, but it does not scream capital efficiency. For context, the sector has historically rewarded companies whose return on invested capital meaningfully exceeds their cost of capital. 8.7% sits in acceptable but not exceptional territory for a firm of this scale. The gross margin of 42.37% reflects strong pricing power at the top of the income statement. This is the revenue left after direct costs. The operating margin of 21.7% demonstrates that, after accounting for overhead and operating expenses, Marsh retains roughly 22 cents of every revenue dollar as operating income. The net margin of 14.26% is the bottom line after interest and taxes, and is respectable for a financial services intermediary. Perhaps most telling for long-term investors is the free cash flow margin of 17.91%, free cash flow being the cash the business generates after capital expenditure, which management can use for dividends, debt repayment, or acquisitions. In our view, the profitability profile here is the strongest dimension of the investment case, and the StokTok profitability score of 13 out of 20 reflects that. Onto growth. Is this business expanding, and at what rate? Over the trailing 3 years, Marsh has delivered revenue growth of 9.2% on an annualized basis, a steady mid-single-digit plus trajectory that reflects the resilient demand for risk advisory services even in uncertain macro environments. Extend the lens to 5 years, and the picture is similarly consistent. Revenue growth of 9.8% annualized. That 5-year figure is actually marginally higher than the 3-year figure, which in our view suggests the company has maintained rather than accelerated its growth momentum. A pattern worth monitoring as the organic growth rate begins to compress slightly. Book value growth over 3 years stands at 13.6% annualized. That is the rate at which shareholders' equity has compounded, and at 13.6%, it is a constructive signal about retained earnings power. On the income side, Marsh pays a dividend yield of 2.05% at the time of recording. That is not a high yield by income investor standards, but it reflects a commitment to returning capital while maintaining balance sheet flexibility. The growth score of 11 out of 20 in the StokTok framework captures the view that 9 to 10% revenue growth is solid but not exceptional, and that any deceleration from the 3-year versus 5-year comparison warrants watching. The data suggests the growth thesis is durable, not explosive. Now let's talk smart money. What institutional capital is actually doing with this name? 16 top-tier guru investors currently hold positions in Marsh, which tells us the name is on the radar of sophisticated long-term capital allocators. However, the directional picture is more nuanced. Among 13 institutional filers, these are the quarterly filings that disclose large money manager positions. Only 8.3% are net buyers. That means the overwhelming majority of institutional filers are either holding steady or trimming. A reading above 50% would indicate broad bullishness. 8.3% is a signal that institutional conviction, at the time of recording, is not strong. Looking at specific guru holders, AKO Capital holds Marsh at 4.19% of their portfolio, but has been reducing by 17.5%. Jensen Investment Management carries it at 3.17% of their portfolio and has cut the position by 54.94%, a significant reduction. On the other side, Torrey Funds has been adding, increasing by 39.51%, and Thomas Gaynor of the Markle Group has made a small add of 0.89%. Yacktman Asset Management has also added 11.16% to their position. The picture is genuinely mixed, some credible names trimming meaningfully, others adding. Insider ownership sits at 1.38%, which is low, meaning management has limited skin in the game relative to what we would typically want to see. In the most recent 3-month window, there have been 0 insider purchases and 3 insider sales. That directional signal warrants caution, in our opinion. And finally, the verdict. Let's bring it all together. On valuation, the GuruFocus intrinsic value estimate implies a nearly 30% discount to fair value at the time of recording, and the forward multiple is more attractive than the trailing one. But the low StokTok valuation score reflects balance sheet risk that the simple price-to-earnings ratio does not capture. On financial strength, the Altman Z score gray zone reading, the thin cash-to-debt cushion, and elevated debt-to-equity of 1.54 collectively suggest this is a balance sheet that demands monitoring rather than one that inspires confidence. On profitability, this is the brightest dimension, gross margins above 42%, a free cash flow margin approaching 18%, and a respectable operating margin of nearly 22% speak to real pricing power and earnings quality. On growth, 9 to 10% revenue growth over trailing 3- and 5-year periods is consistent and durable, though the marginal deceleration from 5-year to 3-year bears watching. On smart money, the picture is the most cautious. Low insider ownership, 0 insider purchases in the last 3 months, 3 insider sales, and only 8.3% of 13F filers as net buyers. In our view, Marsh is a high-quality franchise operating in a structurally attractive industry, but the current setup, with balance sheet leverage, insider selling, and limited institutional buying conviction, warrants careful position sizing and patience. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Marsh. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.